You walk into a bank, hand over $1,000, and the teller smiles. Naturally, you assume that cash is heading straight into the back, sitting in a secure vault guarded by a dragon. This diagram shows what actually happens. Your deposit splits instantly. The bank keeps $100 in reserve and immediately loans the other $900 out to someone buying a jet ski. This system expands out to everyone. It is called fractional reserve banking. The entire model relies on the mathematical probability that you, and all these other depositors, won't show up on the exact same day asking for your money back. Banks operate as financial matchmakers, bridging the gap between people with surplus cash and those willing to pay a premium to borrow it, generating a profit from the velocity of your money. But before you can even think about saving your money, you have to actually collect it. You work a hard month, check your pay stub, and realize a $2,000 salary somehow translates to a $1,400 deposit. You scroll down the lines: federal income tax, state tax, Medicare, and of course, Social Security, which is effectively the government forcing you to save for your own retirement. This mandatory chunk of your money is the cost of civilization. The government takes a cut to build roads, fund schools, ensure local restaurants meet health codes, and maintain the military. Your starting wealth is structurally handicapped before the money even clears your account. The government serves as the very first, invisible participant in your personal finances. Once you have what is left of your paycheck, you encounter interest. When you borrow money, interest acts as the ongoing price tag for holding someone else's cash in your hands, slowly turning a small credit card purchase into a massive liability over time. This chart illustrates the danger. A flat line represents simple interest, a basic fixed fee. But the curve that shoots upward represents 20% compound interest, where your debt essentially clones itself and the interest starts charging rent on the interest. Then there is inflation. That physical stack of bills might still technically say it is worth the same numerical amount, but its actual utility is slowly eroding. A $5 bill buys less food and less gas today than it did a year ago. This happens when excess cash floods the market. If 2,000 people have the money to buy a specific television, but the store only has 1,000 units in stock, the business raises the baseline price to match the demand. Because of these two forces, standing completely still financially means you are actually moving backward. If you are not actively beating debt interest and market inflation, the system will quietly drain your wealth while you sleep. When you try to navigate this system, you run into your credit score. It operates like a shadowy 3-digit algorithm, tracking your payment history and how much of your available credit you are actually using. That single number judges your financial trustworthiness. It dictates whether you can buy a house, rent an apartment, or get a reasonable interest rate on a car loan, and it functions completely independently of how much actual wealth you have in the bank. But the biggest illusion in the entire system is the fiat currency itself. A paper dollar has absolutely no intrinsic physical value when compared to a rock or a stick found on the ground. The only reason that paper holds purchasing power is due to a shared societal belief that it does, backed by strict central bank regulations designed to stop the government from printing so much of it that it turns into monopoly money. The modern economy is largely a psychological game of trust. And once you understand that these rules are entirely constructed, you can start learning how to leverage them. Imagine picking up an average gray rock. Now imagine that rock is shiny and yellow. Gold is mathematically rarer, but it only holds worth because human beings perceive it as scarce and decide to value it. When Steve Jobs created the iPhone, he generated massive perceived value. As a result, millions of people willingly traded thousands of their paper dollars to obtain that specific product. The way you capture that value for yourself is through investing. Investing serves as the active mechanism to convert your static, eroding cash into working assets that either capture or generate societal value over time. To combat inflation, you can buy these assets in several forms. You can purchase tiny ownership slices of public companies, lend your money out through institutional bonds, or buy real estate for someone else to live in. True wealth isn't achieved by hoarding and depreciating paper currency. It is built by actively owning the structural assets that produce the things society demands. But none of those assets function without time. Most people trade their time directly for a paycheck, hour by hour, but time is actually the single most powerful, finite asset you have for building wealth. When you apply time to compound growth, it acts as a mechanical multiplier. Money sitting quietly in an investment doesn't just grow, it clones itself. Consistent growth given enough time allows modest investments to snowball, eventually out-earning the very people who trade their labor for a paycheck. While the economy operates on constructed belief, time is the only resource that is truly finite. Once you understand the mechanics, the question shifts from how much you can earn to how much of your life you are willing to spend.